So Mark goes on to say, SM is a good example of my struggle. I get an intraday really well. I close the day and I'm up, 1 or 2%. So my entry is good intraday, but if I keep it for a swing or a longer term move, it turns into a 5% loser the following day. I don't know how to overcome that. Now I don't sell, but why do I get a precise entry intraday when the next day is just a 50-50 flip that you're gonna, move lower? So this really goes back to building your strategy to understand your ultimate goal. So this is, for Mark, or anybody with a similar struggle who has this frustration where I had this 2% winner turn into a loss. Why did I do that? Your strategy has to match your blueprint. So you have to have a belief about how your system works, what you're trying to capture. You have to either change your blueprint to match your personality or convince yourself and change your personality to match your blueprint. So by that, I mean, if you're trying to catch these long-term trends, you have to believe that it's not a 50-50, flip the next day, or even if it is a 50-50 flip. If you bet on heads, it's a 50-50 flip, but you're right, your gain is going to be much bigger than your loss. If you don't resolve the struggle between what you believe internally and the kind of system that you're trying to apply, it's called cognitive dissonance is the kind of the psychological term. And so the actual definition of cognitive dissonance is that it's the mental discomfort from that results from holding two conflicting beliefs, values, or attitudes. People tend to seek consistency in their attitudes and perceptions. So this conflict causes feelings of unease or discomfort. And it's true. And I've experienced this myself. So I whenever I had my best years, I'm always kind of followed by a year that's not that great, one of my worst years. I realized at a certain point, I was going through cognitive dissonance in that when I'd have a really big year, kind of like make a lot more money than I expected to make, something really, really good, I would start to tell myself, okay, I'm not going to give this money back, but I would keep trading. Now, what would happen is every time I'd lose $1, it'd be like, like a knife in the back. Like, why did I give that up? I said I wasn't going to give it back, but then I keep trading. So I'm trying to now accomplish two things that are incompatible. I'm trying to make money in, volatile stocks that are not a smooth way up, but I no longer have a risk appetite. So suddenly my strategy and my internal desires are no longer kind of working together. And usually what's happened in the past, I go through months of struggle. And I mean like poor nights sleeping, stressed out during the day, worry. And until a final point where I would get fed up. And this has happened to me a few different cycles where I say, you know what, I don't care anymore. That's kind of like where the Caruso dollar stop came up. It was at the end of one of these struggle periods where I said, look, I have to live with it. This is what I'm going to live with. If it works, it works. It doesn't work. That's the cost of being, in the business. And as soon as I would resolve that struggle and I got that mindset, bang, I start to make money again right away. If you want to apply a strategy like this, you have to get your blueprint and your mindset to be on key together. So why are we holding on when we have a small gain, only when the next day is a 50-50 split? Well, take a look at Mosaic. With the kind of booming fundamentals, the backstory, this is what we're trying to capture. I mean, if you have, now, for example, I have a 40% position. It's 40% of my account rather. And I'm sitting at, from 45, it's 61. What is that? 30% gain. If this keeps running, and there's enough reason why this can keep running, given the price action, given the supply constraints, the demands, inflation, et cetera, et cetera, et cetera. If this goes to $120, massive increase in my overall account portfolio, huge. If I have a 40% position, let me just see this right here. So if this goes to 120, let's say, which is a double from here, it's not earth shattering. So if we go from 120 a cost, so 120 divided by, let's say my cost is 45. Let's say I don't even add another position anywhere. So that's 160% increase times 40%. No, sorry. So 40. Yeah. So I would increase my entire account by 65%. I would have an entire 65% account gain on the year from one position. Now, 65% gain on an account year is probably what most people would love to have if everything is going well. Imagine getting that from only one stock. Imagine if multiple stocks move for you and you're right on your trend. That's what we're trying to capture. The kind of tech moves in 2020, 2021, these moves happen all the time in different stocks, different points in time. So you have to go back in time, look at all of these winners. You have to understand that we're putting all of this together, the fundamentals, the technicals, to set up not necessarily that you're going to be right 60% of the time. I'm typically not right 60% of the time. And for periods of time when I'm right about the trend, I'll be right 60, 70% of the time. But overall, I'm usually right less than 50% of the time. But you're looking to capture these significant gains. Now, it's all about not how right you're going to be. It's all about expected return. So what's expected return? Okay. I mean, I know Dalio talks about this. I learned this in my CFA studies and I love the concept. So expected return is you want to take your probability multiplied by your outcome. So for example, if you have a 50% chance of making $100, your expected return is $50. You're going to win one, lose one. You eventually, if you do that often enough, your expected return for each trade will be $50. It's going to average out over time. So maybe if you look at one day to the next, yeah, it's a coin flip, 50-50. But if that's the way you approach it, and you one day you take a 2% gain, then the next day you take a 2% loss, maybe your expected return is your percentage will be 50-50, better than 30-70. Let's say you only win 30% of the time, but you're not making a lot of money. If I'm right 30% of the time, but instead of making $100, I make $1,000. I'm right less than 50%, but in this example, my expected return is 300 versus the 50. So I'm willing to accept the lower probability because if I am right, I'm going to make a lot of money. Now, for example, think of expected return. There's different ways to look at that. Sometimes the outcome is so terrible, no probability is worth it. For example, let's say a war zone, let's say a minefield. Okay. If I said, look, I'm going to give you $100 million, you have to walk through that minefield. It's a 10-mile minefield. You say, well, look, if I get out of there, it's great. I make $100 million. What's the cost to me? If I step on a mine, I die. So I don't care. The outcome is so negative that I don't care what the upside is promised to me. If you multiply the probability of hitting a mine, let's say it's even only 20%, but 20% times my life, there's no monetary value that will offset that. So that's the concept of expected return. So you have to believe when you're applying this type of strategy, it's not about being right 51% of the time. It's not about being profitable over the next month or two. It's about consistently controlling your risk until you line up a great position in a stock like Mosaic, where you have a significant portion of your account invested, and then you dramatically increase your account. To do that, you have to be consistent, you have to be diligent, and you have to keep working at it. I mean, it's been 2 years of tech stocks going crazy. Longer than that, go back in time, but 2 years of really going crazy, but go back in time, it's been just years of it. Who would have thought that a company selling fertilizer, and I can use some other, less politically correct words for fertilizer, of what that really is that you're buying for the crops. Who would think that would have a potential for such an enormous move? How did we find it? The fundamentals were there, the technicals were there, all of the strategy clicked in. So you have to believe, you have to understand that the strategy is built in such a way that you're finding not just the ability to be right 51% of the time more than you are wrong. So like 51 versus 49 that you're wrong. But when you're right, you're going to be really right. And you're going to have a really big position. And you have to believe, you have to understand that the fundamentals you're seeking, you're trying to find the trend of these companies that are changing the way we live, work, or play, or they're on an industry trend that's really being affected by current global dynamics right now. And you have to also understand that the charts are showing institutional accumulation. So there's money flowing in. So when you put all of that together, you say, look, I may be right only 3 times out of 10, but when those 3 times are right, I'm going to end up with a full position, and that stock's going to advance significantly. And that's going to outweigh all of the losses that I get along the way. Like I mentioned, I got stopped out on CF, frustrating. I would be having a much better year if I had CF along with Mosaic. I forgot about that loss. Right now I have a 40% position in Mosaic, a 1/3 position in SQM, which is partially fertilizer. If fertilizer is going to go crazy and it pulls at a 2008, I'm going to be very well rewarded. So it's about that consistency and that diligence and understanding the total scope of the strategy. If you stay fixated on trying to keep that small gain, why did I get back that small gain? You're not keeping in mind the bigger picture of what you're trying to accomplish. So you're looking day to day when your strategy is not built for day to day. You have that cognitive dissonance. So it'd be up to you to either change your personality to match your strategy, really absorb, take the time, look back at past winners, review the course, and understand, why am I going through all of this trouble to look at earnings and sales and the depth of bases and relative strength? Why am I going through all of this? Do I really believe that this is the way that I'm able to find these next major winners? I do personally believe that, because I've gone back and I've studied all these stocks. I've seen them in real time. I've done it myself. So I'm at the place in my life where I truly believe it. I don't just know it because I've read about it, but I believe it because I've experienced it. And so, if you haven't experienced it, you have to at least read about it and study enough so that you have a deep knowledge and at least somewhat belief in it. So if you can't get to that point, you're never going to have, you're not going to be very efficient in applying the strategy, and you're always going to be under a lot of stress. It's amazing once people believe in something, how hard it is to break it. I want to bring up the fact that I posted about this here on Twitter on Friday, or I think it was Friday. I said, Roku pins, JMIA, DD. This is why the concept of holding a growth stock for 5 years based on projected growth doesn't work for me. And I believe it is dangerous. There's a time to buy, there's a time to sell. For every apple that works, there are thousands that don't. So what I was trying to get to the cusp of, and it's hard with 160 characters, is that, everything we do to find these great growth stocks is amazing. That's what leads to these huge moves. You have to know when to sell. To just blindly hold because the company says this is what I'm going to do over the next 5 years doesn't work. And I showed all of these charts, that they're all down 70 to 90%. This is Jumia, this is Pinterest, this is Roku, and this is DD. And obviously there's some people who follow me. They kind of know the Can Slim process, my process, and growth investing in general, and they agreed with me. But there's still a lot of people who mentioned like, oh, well, you have to wait 5 years, or it's not a fair comparison because they didn't have big enough earnings, or oh, it was clear to know that they were going to have some kind of regulatory issue, or Jumia was Africa. That's not the point. You see, they're so ingrained with them, or they have this internal belief that they don't want to accept that they're wrong and sell, and that they want to believe that this 5-year projected growth is all that matters, is they won't even acknowledge that an 80 or 90% stock drop means that they're wrong. In my opinion, you're wrong. Some people say, well, stocks like Amazon.com did it. Sure, there's always something that's going to break the mold. But at the same time, if you bought Amazon in 1998, there were no earnings yet, and the stock crashed below your cost, and you had to have never taken a profit over the 20-year advance. I don't know too many people who did that besides Jeff Bezos, who was running the company. So there's always going to be exceptions, always easy in hindsight. But this is an example of, you have to believe in what you do. And if you don't, you're never going to be able to abide by it. And these people are so convinced by their 5-year growth outlook that they're willing to sit through 90% drops, or at least argue for that kind of situation. So if you want to follow this approach, Mark, it's just really important that you take that time to really understand exactly why the growth drivers that we discuss in the course and the charts, and why they're important, and what they're going to lead to. And the best way is to really go back, study winner after winner after winner, and just see how these factors are always constantly recurring. And you have to remind yourself all the time, this is not for a 1-week gain. This is not for a 2-week gain. We're trying to find these life-changing moves that when you do find them, like I'm in Mosaic, I'm ready to hold this for 2-3 months, 9 months if I have to. And that's where these staggering moves really come from. And you have to look also at these past winners. It takes time. Trends take time. There's no way around it. Even people who, who look for these stocks, and then again, they overestimate what can be done in a day, and they underestimate what can be done in a year. And the reason I brought up that poll at the beginning is that even though maybe Mark is really articulating his struggle very well, and maybe he's experiencing it a little bit more than some others because he has more of an internal frustration with it, the concept of expected return, now everyone can see the results of the poll here. So 40 people answered. 29 out of 40 said they'd rather take a sure $500. I asked, what do you prefer? Would you rather be given $500 or a chance to win $1,000 on a 50-50 coin flip? This shows that most people are risk averse. The reality is the expected return is exactly the same. So here you have a 50% chance of making $1,000. That's $500. Or you could be given $500. So the outcome is exactly the same statistically. Yet investors, human beings in general, are risk averse. They like certainty. They don't like to lose money. Even if I said, I'll give you a 60% chance to win $1,000, I bet you people still would have chosen the 500. They want the sure $500. So people don't like that pain of losing. And so what Mark is, you're part of what you're going through too, is also that risk aversion. I had that 2% gain, and now I'm at risk of losing that fight. Why don't I take it? I'm at risk of losing it. And you have to understand that that's a kind of a built-in fear that we all have to overcome. And you have to really believe that, again, all of these things are coming together to find these asymmetric, these life-changing moves. Even here, when you ask the general people, they prefer safety, they prefer consistency, they prefer knowing a certainty rather than an uncertainty, even though these are exactly the same. So again, in this situation here, it's important that you really take the time, Mark, to understand what the strategy is. I know I kind of really went at length here, but this is a problem that I know affects a lot of people. It's affected me in the past in different ways. And to get the most out of this strategy and really get those life-changing returns, the general answer for this is that your blueprint, your strategy has to match your internal beliefs, or else you're going to have a really bad time applying this strategy or any strategy I mean, if you try to apply a value investing strategy, but you want big returns or you want to invest in technology companies, it's not going to work for you. You have to find your strategy that's got to meet your personality.